paychecks, taxes, and benefits. So, here you are, out in the working world, just beginning down the path toward a long and fruitful career. Of course, when we say fruitful, we mean you're getting paid. Depending on your job and your employer, paychecks can be very different and occasionally confusing. Let's take a closer look at the elements that make up a pay stub and make sure you understand everything you're getting, in cash and in benefits, for the work you do. Pay stubs or statements come in various forms. They might appear online if an employer uses an electronic payment system. Some employers still distribute actual checks with paper statements attached or enclosed. Whatever the case, it's always a good idea to know where to find your stubs in case you need them. Generally speaking, the first thing to look for when you get a pay stub is your gross pay. That's the total amount you've earned in a given pay period before taxes or other withholdings. The net pay is the actual amount of money you're receiving after taxes are deducted. Many pay stubs will also include your year-to-date earnings, abbreviated as YTD, to help monitor your annual income and make you better equipped for filing income tax documents at the end of the year. The difference between your gross pay and your net pay depends on factors such as tax rates and employee benefits. Federal income tax, state income tax, Social Security, and Medicare are all commonly withheld from regular paychecks, and you'll typically see the amounts noted on each pay stub. Some employers provide health insurance benefits for employees, the cost of which may be noted on your pay stub. But if you're trying to calculate how much a job-based healthcare plan is worth to you, it's often worth looking at more than simply what's deducted from your pay. Consider other factors such as how often you and your family members visit the doctor, or whether certain conditions or treatments are not adequately covered. With some plans, your healthcare costs might only be covered up to a certain amount. Alternatively, you may be responsible for a deductible, an out-of-pocket threshold that must be reached before your employer's insurer kicks in. Some insurers also require employees to make co-payment for certain types of doctor visits. All of these factors are worth noting when trying to figure out what a job-based health insurance plan is worth. When it comes to healthcare plans, you might encounter acronyms that can sometimes sound like a confusing alphabet soup. Here are some terms to be familiar with. HMO. It stands for Health Maintenance Organization. HMOs tend to be less expensive than other providers, but also carry more restrictions on which doctors you can see and when. PPO means Preferred Provider Organization. A PPO typically involves a network of pre-approved doctors and low co-payments for many kinds of care. HSA stands for Health Savings Account, and it's pretty much what you'd expect. A special type of bank account that lets you set aside money for healthcare expenses, tax-free. It is only available for those enrolled in a high-deductible health plan. An FSA is a flexible spending account, which has tax-free benefits similar to an HSA but can be used in conjunction with a traditional health plan, like HMOs and PPOs, to cover other qualifying expenses. The funds in the account expire, however, and need to be used in the same year it was deposited. COBRA isn't a deadly snake, but rather an acronym for Consolidated Omnibus Reconciliation Act. If you lose your job and/or health benefits, COBRA is a law that allows you to continue those benefits at an adjusted cost. By the time you're reading your pay stub, you should have a better idea about which of these terms applies to you. In the next segment of this series, we'll explore the world of investments and how they can affect your future finances as your earning power grows.